earlier you take some steps to fix the situation, the more options you've got. We have always said that. And so certainly the first thing to do is see, well, okay, can I convert high interest debt into a lower interest kind of borrowing? So, getting a line of credit and, getting rid of your credit cards kind of thing, whatever you can do to reduce the amount of interest you're paying so that every payment you're making actually does something.
All right, so we are now in the second half of our show. We are now diving into risk trends, some of the bigger pictures that you're seeing, and I think we left it off with tariffs. And what are your thoughts on that? Or I think even as well too, what's happening with the war in Iran, and what does that mean in regards to inflation, and I think also confidence in the marketplace, because that also is a huge factor when we're touching and talking about all of this stuff.
Yeah, no, exactly. I mean, I think that consumer confidence is a big factor. It drives a lot of our decision making. Do we save money? Do we spend money? Are we going to deal with our debts now or, postpone it till later? All of those kinds of things are a factor. And then all these sort of factors going on outside of Canada that we can't control, and our feelings about all of that. So, I mean, yeah, right now, I mean, obviously we've got some conflict in the world, particularly given, the Iran conflict right now. That's affecting oil prices, and it will for, some time, unfortunately. So that's another inflationary pressure right there. People, go to the pumps one day and the next day they go and it's 30 cents higher or whatever per liter. And that's, a shock there as well, and takes a bite out of their budget. And of course, it's unfortunately, I think we would have hoped that by now things would have sort of, I think, stabilized or calmed down with respect to, the U.S. and tariffs and all that sort of negotiation that, I think really just still has to happen to a large extent. But there's still a great deal of uncertainty there because we're not sure exactly what's going to happen. Obviously, Canada is trying to align itself now with other trading partners to try to their positioning with tariffs. But I think generally speaking, there's a lot of pressures going on right now, and that coupled with some of the other things we talked about earlier is causing some people to, say, well, yeah, I don't think I can do this anymore.
Yeah, for sure. With that being said, are you seeing people that also reach out to you with inflation, with the tariffs, with job losses? Are you seeing a lot of job losses happening?
So far in my area, not too much. I know there's probably some other areas of the country where my colleagues have seen more of that. I think there's been a lot of efforts to try to, to offset that in some way so that people have, other opportunities that they can avail themselves of. But I mean, we certainly are seeing, like in the automotive sector and things like that, there's an impact there for sure. And, it's maybe a little too early to tell whether there's going to be people displaced that can't find alternate work relatively easily. And that, then obviously, yes, we've got, things that can prop them up for a while, like EI and so forth, but, that's only temporary. And, if they can't find alternate work at a comparable income level, then that's going to have an impact on their finances and their ability to service their debts and pay their bills. So that's for sure.
I'm going to ask you to take out your crystal ball for a quick minute here. and I do want to ask a question just in regards to what potentially is going to be, well, what will be happening this year is where I think we're about 40 or 50% of mortgages are coming up for renewal. Mm-hmm. And with that being said, they're obviously moving from interest rates, maybe, 1.25, 1.5, 1.75 up into the high threes, maybe even low fours. What are your thoughts on that? Any concerns with that headwind coming around?
Yeah, I'm concerned about that still. I think that And I think for anyone in our industry, it's been always that for the past couple of years or so, it's been that sort of waiting for the other shoe to drop kind of thing. Because I think that for a lot of folks, they're going to find that the increased monthly cost of their mortgage will go up, and they're going to find it's more difficult to meet that obligation. And for a lot of folks too, there was a period of time because real estate was inflated to the degree it was, there appeared to be more equity there than they really had. And maybe it was a bit of an illusion, or maybe everybody hoped that the property values would stay at the height that they were, but they borrowed against them. And so sometimes you got a first mortgage, you got a second mortgage, or a secured line of credit, and a lot of those things have been used a fair bit. And so now we're finding that with property values declining, some people are in a jam. They're finding that they really are having trouble servicing the mortgage or the encumbrances on the property, and but they also are looking at the real estate market and going, well, gee, if I sell, I'm either gonna, if I'm lucky, I'll break even. If I'm not lucky, I may actually be in a shortfall position. And so that's some of the things I'm encountering more now than I was in the past.
Right. So you're potentially even anticipating that these real estate prices will continue to keep sliding, or at least maybe just going sideways. And then also too, you've got the pressure, downward pressure of the condo market as well.
Yeah, the condo market's huge, particularly in the GTA. Like, I mean, there's some folks there that have condos and they just cannot sell them, at least not for any price that they are willing to accept. And it's not because they're being, greedy about it. It's because they need the price point in order to be able to clear off the mortgages that they have. And it's a difficult situation. I mean, for a lot of folks, they're trying to, hopefully, like, they rent for a while to try to stem the losses, but in many cases they're having to kick money in over and above the rent they're getting for in these condos in order to just get by, hopefully to a point they're thinking in a few years when the market will recover and they'll be able to sell. But I don't know whether that's going to happen anytime soon. It seems like at least for 2 or 3 more years we may be in this slump. So it's hard to say what's going to happen there. But yes, the renewal side of it, absolutely. I think a lot of people, in spite of the fact that interest rates have come down, certainly off of their peak, they're still higher than they were when these people got the mortgages that they currently have. And they're going to find that there's some sticker shock when they get that renewal notice, and they're expected to pay more per month, quite a bit more per month than maybe their budget really even allows for.
Yeah,
Yeah,
so some of what you're saying, and I think I agree with you, is that there's probably going to be more financial pain, more crunches happening this year, probably even into next year as well too, where people are trying to either shuffle around debt, try to offload their condos, and put themselves into better financial situations. But it's difficult, and I see it on a weekly basis. From phone calls that I get, and people wanting to know if I've got anybody who would like to buy their condo, and it's just there isn't an appetite for condos right now. But there will
no,
eventually, it'll come around, but I don't know how many years that's going to be, right?
sure,
4 years,
exactly,
five
right.
years.
And it may be also that may be a function of changing demographic too. As more people get older, they may prefer a condo lifestyle because it's obviously you don't have to worry about shoveling snow and doing all that kind of stuff, right? But
Yep.
the market may not be there yet. There's still a lot of retirees, sitting in their 3 or 4 bedroom home, and they don't want to leave yet. So there's that factor too, right? So it's a strange market we find ourselves in some respects, right? So
Yeah, for sure.
yeah.
Now I saw an article come out. I didn't get a chance to dive deep into it, but I mean, I know Go Easy, Easy Financial, they've obviously been having some difficulty, and I think about $1.2 billion got wiped out, I guess, of like some bad debt. Can you touch on that? And also maybe just share what are your concerns on that? Like, do you see that there's maybe a bit more of a debt crisis ahead of us in the financial system?
Yeah, I think that, I mean, this is one thing that's very different, I think, about the North American experience with credit versus other parts of the world is that, lenders will offer to lend. And as long as, you reach a certain threshold in terms of your credit worthiness, your credit rating, you get the credit. There's really no analysis to see, well, can you really afford this, or what other credit do you have out there, that kind of thing. So I mean, a lot of these lenders are, particularly the finance companies and payday loan companies, they're high risk lenders. They know that they're lending sometimes to individuals who are already pretty heavily saddled with debt. And it's a situation where they are going to have to to pay all of this. And so at some point, there's going to be defaults. It's just it normally it's built into their kind of business model anyway. They know they're going to lose a certain number of accounts, but because of the this rather generous interest rates that they charge, they find that they're able to make it back in many cases. But they're also expanding what they're doing. I mean, a lot of the payday loan companies are now, it's not just a payday loan till next week. It's lines of credit and things like this. And even some of the finance companies are expanding their lending into the real estate market, where they're assuming maybe a third mortgage position where they're only semi-secured and maybe ultimately unsecured because of the drop in the real estate market and the values of the properties. So, that does expose them to more risk. And I mean, there's going to be a time when, for a lot of the people that come to see us, where they just can't service the debt anymore. It's just too much debt, and they're struggling to make the payments, or they're juggling the payments around, as they suggested. They're throwing money here and throwing money there just to put out fires. Really, is all they're doing, and they're not really addressing the overall problem.
Right.
So to some extent, you say, well, there's one camp that says, well, people shouldn't sign up for debt that they ultimately can't pay back. The other side of the camp says, well, gee, maybe the lenders shouldn't be lending, the way they are. They take on the risk, and if they calculate poorly in terms of that risk analysis, they're going to lose money, and it's not always the debtor's fault. There has to be some responsibility on the lenders as well. So, different minds on that, different opinions on that. Whatever it is, I have people coming to see me because, for whatever factor is involved, they're just unable to cope any longer. So
Yeah, I mean, almost any way you slice it, like, it definitely looks like the lenders are potentially a part of the problem. And then you also said something where that they're moving into the real estate world. Is this something new over the last couple of years, or is this how long has this been going on?
yeah, I don't think it's completely new. I think they've kind of moved in and out of it depending on how they saw their opportunities. But what I have noticed in the past few years is that when someone goes looking for additional mortgage financing, and they've already exhausted the A lenders, and they're into the B or further down the list with respect to their second, and then they're still looking for some kind of financing beyond that. Some of the finance companies are stepping in and saying, well, okay, yeah, we'll lend on whatever remaining equity there is in the property. But that amount of equity can disappear pretty quickly if the market shifts. And again, fair market value is what someone's willing to pay for something, and that changes. And right now, especially in smaller communities, I mean, I service and serve a number of smaller communities throughout Ontario. And what happened during the pandemic was that, of course, there were a lot of people that made an awful lot of money selling their house in the GTA, and then they moved out into the smaller communities and didn't really have a sense, perhaps, of what property values were out there, and I would argue, overpaid for those properties, which inflated the value of those properties in that community by a disproportionate amount. And now the people in those communities are having difficulty affording the properties in those areas. But it's a matter of with those smaller areas, when you go to sell your property, it doesn't take very many properties to be up for sale before there's too many, and there's too much. It basically becomes a buyer's market because there's not enough people able and willing to buy those properties, and then the property values fall even faster. So where property values might be buoyed a bit in the GTA because there's lots of buyers and potentially quite a few properties available, in smaller communities, it only takes 10 houses to be up for sale in a small town of 8,000 people before you've got too many properties on the market, and then it just depresses all of the prices.
Yeah, I mean, I do a lot of work out here in Durham. We also do stuff out in Peterborough and just on some of the outskirts, and we've seen it where some of these homes went up into the say 600,000-700,000 price range, where all of a sudden now they're back down into the 300 price range. And,
Hmm.
the concern there now is, some of these people who moved into some of these homes or properties, those first time home buyers that want to move up in 5 years probably are not going to be able to move up in 5 years. And so, you've got a completely different headwind down there of like, well, what does that look like in the market when we come to that place, right? So there's a lot of different moving pieces that are happening, and you're moving into a space where we probably never seen anything like this before. So it'll be interesting to see.
Yeah, the only analogy I can draw is like the early 90s, something similar happened. There was a sort of a real estate bubble, and then it kind of popped, and there was a significant downshift in the property values.
Yeah.
But yeah, I mean, it's, you feel for people that, particularly first-time home buyers, that are going to be disadvantaged by this. They've got potentially a mortgage that is as big as the value of the property at this point, and no ability to refinance or pull any equity out because the equity is simply not there anymore. And for a lot of those same folks, it's maybe it was a little bit naive on their part, but for some people that are first-time home buyers, they look and see, well, can I afford the mortgage payment? Can I afford the insurance, the utilities, and all that kind of stuff? And they arrive at their new home and realize that, well, gee, I don't even have a lawnmower, I don't have a snow shovel, I don't have a couch, I don't have whatever whatever that thing is. And then oftentimes they end up using unsecured credit to buy those things with, and then that puts a strain on the household budget because now they're paying for all these things at a fairly high interest rate, obviously, and all those kinds of things. So it's, owning a house is a great thing. It can be a great investment. It can be, you have to live somewhere. So if you're paying your mortgage and you're building equity in your house, that's great. But it is also a liability, and people have to understand that there's upkeep and maintenance that has to be done, and you're going to have to buy things that you didn't have to buy when you were in an apartment. So
Yeah.
that's a thing that sometimes people lose sight of, particularly first-time home buyers.
And that's such a great point too, because when I was a first-time home buyer, the same thing. That first 4 or 5 years, I don't have all of those equipment that I need, and so
Hmm.
you end up buying them on credit cards or lines of credit, and then 5 years goes by, and you're like, oh, I'll just dump this into my mortgage because my home has gone up in value. But a
Yeah,
lot of people won't be able to do that at their 5 year mark, right? So yeah, it's an interesting point that you raised there for sure.
yeah,
The other thing that we touched on before we hit record was co-signers. And so
yes,
now you got a lot of co-signers tied up into whether it be their sons, their daughters, in-laws, and now their name is on their kid's mortgage. Are you seeing a lot of that? And they probably come and they're like, "Hey, look, I need to get off of this because I need to do something now," and they can't. So you've seen a lot of entanglement.
yeah. Definitely seen more of that because I mean, a lot of parents do try to help their kids out, and so they'll end up going on, and maybe they're only listed as a 1% owner of the property, but they're on the mortgage, right? And they're basically there in a guarantor kind of fashion. And so if something goes sideways with the kids and they're having problems, and then again the property values may be going down, they're going to have trouble on renewal. So sometimes then the parents end up having to try to bail them out, or they're having their own financial difficulties. That is the parents, because unfortunately, as parents, we're sometimes a little too generous with our kids. And so I've seen many instances of that where basically the parents kept helping to the point of their own detriment, where they then couldn't pay their own bills, or they were using their own credit to try to shore up the kids. And, at some point, that causes both sides to suffer. So, yeah.
Yeah, for sure. You know what? I don't like always giving financial advice, but I'm going to give some financial advice. Here's what I did for my son was
Okay.
that, for me, I didn't want to just give him the money. And so I said, look, you know what? You want to move out. It's time for you to move out. And you can move into one of our rentals. You can be a roommate there. You can learn what it's like to be a landlord. And in 3 or 4 years, wherever the value of the home is and whatever the mortgage has been paid down, then you can use that equity because you're
Okay.
living in there. You're understanding what it's like to cut the lawn and do the snow removal and do all that stuff. And so that's the way that we did it, as opposed to just giving it to him. And guess what? Now our relationship is really good because now he's like,
Yep.
I understand what it's like to look after a property now, right? As opposed to just giving it to them. So, but I
Yeah,
understand. I
exactly.
understand both sides of it. As a parent, you obviously you want to see the best for your kids, but that's the way that we decided to do it. So.
Yeah, no, it makes perfect sense, and I would say I would sort of echo that by saying too that like, I mean, I'm a what you consider to be, I guess, a white collar professional, but I come from blue collar roots, right? So my dad was an electrician, and he was that jack of all trades guy that knew how to do just about everything, and I followed in his footsteps, and I've tried to train my two now adult boys the same thing because it's like, you know what, if you are going to own a home, if there's whatever you can figure out how to do yourself, you're going to save yourself a lot of money because if you have to keep calling all these people in to do work for you, it's going to cost you a fortune. So it's
Yep.
it's good skills to have for sure.
1000%. I agree.
Yeah.
The other thing as well, too, did you see a lot of people come to you after the pandemic and a lot of debt build up with promissory notes? Because that was definitely something as well, too, that I saw a lot of investors doing, or more investors, I guess. But did you see a lot of that?
There was some of it, yeah. I mean, it sort of depended. There's a whole range of borrowing and lending out there, and some of it that was a little more on the informal or shall we say, private lending side did have those kinds of things in it, where there'd be a promissory note, and I mean, if it's been worded properly and properly executed, it's enforceable. So the holder of the note can turn around and sue you if you're not making the payments according to the agreement. So it's valid paper, if you will, and we did see some instances of that. Even one in one case, which actually created a security interest in real property, and that one was a little wonky. It kind of felt like something they pulled off the internet using AI, but it ticked all the main boxes, so it was fundamentally a valid agreement. So. Yeah, it's becoming a little more prevalent, and maybe even more so between family members and friends, right? Where they don't want to necessarily have a really formal agreement, but they want to have something at least that they can go fall back on if the agreement doesn't play out the way they hoped it would.
Right. You've been doing this obviously for a long time, and you've probably seen a lot come across your desk. Um, if you could do this now, like what would you say, or what would you change in the financial system to say, man, if they would just do this, this would be a lot better for families or individuals that are in the marketplace trying to get ahead.
Yeah, that's a tough question. I mean, like certainly because just through my academic background, I've had a chance to look at other systems in other countries, and as I alluded to earlier, in Europe, for example, creditors are held to task a bit more. It's kind of like they're saying to the creditor when something goes sideways and someone has to do a bankruptcy, they say to the creditor, "Well, why the heck did you lend that money to them? That didn't make sense. That wasn't a good decision." Whereas in North America, particularly in Canada and even more so in the United States, the idea of the individual and being the master of your own destiny, they kind of leave everything to the individual, and it's up to you to make the choices about whether you want to take on this credit or not, and less emphasis is placed on the creditor to be more responsible in their lending. So I mean, there are probably some things that could change about our system that way. Maybe some things that could maybe put a bit more responsibility on the lenders. But certainly there are some kinds of lending that to me still seem kind of predatory, and they take advantage of people who maybe are in a state of desperation and they're just trying to make ends meet. And there needs to be, and I think some of this legislation has already come into effect where cooling off periods and things like that are put into place to say, hey, if you feel kind of desperate and you go out and borrow money from this entity, and you realize a couple days later when you think about it that it was a bad choice, you should be able to go back and say, hey, you know what, I'm giving you your money back. I don't want to go down this path. Things like that to give people an opportunity to really reflect on it and to be very clear about the lending parameters, what is being asked of the person. Because I don't know how many times I've had people come to me and say, I went and borrowed money from so and so, and I didn't realize they were charging me 47% in interest. Well, to me, that should be on the front page in big letters. This is what you're paying. Like it shouldn't be hidden in some kind of fine print. So, just giving people the knowledge and the tools to be able to make good financial decisions for themselves, give them every advantage you possibly can, And of course, the other thing, which I understand from some people I know is starting to become a thing, but a lot of people my age and even younger than me have come to me and said, you know, Wes, I really didn't get any of these kinds of life skills when I went through by the education system, elementary or high school. Nobody really told me about, how do I balance my budget? Should I watch out for certain kinds of credit? How should I use credit responsibly? How can credit be an advantage, but also a disadvantage, and all that kind of stuff. But now I understand that there actually is some focus on that in the school system, which I think is great. I think that really will give young people coming out of school, going to university or whatever, an advantage because they're going to have at least some of that knowledge. Whereas now, I always find it amazing. Somebody goes off to university or college, they get their student loan, and almost immediately someone's willing to give them a credit card. And I'm kind of thinking, like, this is crazy. These people have no assets and really aren't bankable in any way, and we're giving them this kind of credit, right?
Yeah.
And without the sort of education to back it up, I think that's a problem. I mean, just in my own life, when this happened exactly with my older son. One day he came home, waving this credit card around that he'd gotten because he went to university, and I guess I figured he was a good bet. And I know he was just doing it to goad me, but I looked at him and I said, "You do know what I do, right?"
Yeah. I've said that so many times as well too, is that, they really, I think, failed a lot of the kids that are in high school of not just explaining to them how a mortgage works and taxes and what's the norm, what do the bills look like in a home, what is credit card interest payments, what does it all mean, when should you pay it off, the difference between an Amex card or something, like all that is so fundamental to really understand, and yet they give them this incredible weapon, like you're saying, as soon as they get to college or university, and they have no clue on how to use it. It's actually incredible. Almost feels like it's a bit of a setup, but yeah, you're right. We're getting close to the end here, and I think maybe we'll leave it on a good note here of maybe if somebody is in finance, if they feel like they're getting there, what are maybe some things that they should do real quick? And maybe that's like in 1 minute, let's say, you know what, if you feel like you're getting there, here's what you should do ASAP.
Yeah, for sure. So, I mean, the earlier you take some steps to fix the situation, the more options you've got. We have always said that. And so certainly the first thing to do is see, well, okay, can I convert high interest debt into a lower interest kind of borrowing? So, getting a line of credit and, getting rid of your credit cards kind of thing, whatever you can do to reduce the amount of interest you're paying so that every payment you're making actually does something. But if you're getting to the point where you realize you're just so underwater that, it's a matter of, whether you can pay rent or put food on the table, that kind of thing, then definitely, come to see a licensed insolvency trustee in particular. I mean, we are licensed by the federal government. We're regulated. There's oversight. They audit us, all that kind of stuff. One of the things I'm concerned about is there are some debt consultants out there that are not licensed, not regulated in any way, and they charge people money up front for their advice, and the advice is often incomplete, if not wrong. So, get the advice from the people that actually know what they're talking about. And again, like I said earlier, if you don't need us, that's fine. We'll send you off in the direction that you need to go. But again, seeking help early is going to make a big difference because you'll have more options usually earlier down the road than if you wait too long. And I know it's hard. You feel shame, you feel embarrassed, you feel sheepish about it. You don't want to talk to anybody about it. But at the end of the day, come on in. We'll have a cup of coffee, or we'll do it virtually, whatever way suits you best. And we'll try to figure out what's the best course of action for you, and then that'll help. So.
All right. Well, Wes, listen, thank you very much for your time again. I really appreciate you doing this with me, and hopefully anybody that's listening got some good tips, some good advice. And I think that's part of the problem is that, they feel shame, and I can understand that, right? So, don't feel that way. Reach out, have that phone call, and my alarm is going off there. But have that phone call and reach out to, and if they are ready to do that, what's the best way to do that? Is there 1-800 number? Is a email that you can provide?
Yeah, so I mean, we're easy to find. If you just go to MNP Debt, ONRI.ca. You can find us online. We have a bunch of information there about the things that we do and things that we offer. There's even a couple of cool things on there where you can kind of plug in your debts and figure out what your debt load is, and
Very cool.
whether you might be in trouble or not, and or maybe reassure yourself that you're not. So there's some interesting things on there that people can read up on first, and then through our website you can either book a consultation directly or send us an email to request a conversation or to set up an appointment, and we're happy to do that. And as I said, there's just as a quick note, there's about 1,000 licensed insolvency trustees across Canada. That's the total number of them, and about 80 of them work with MNP. So we're a significant number of them, and we're across Canada. So you can find us everywhere.
Awesome. Wes, thanks again, man. I appreciate it. And all the best in your retirement, but I know you're still going to be active because that's just who you are, and you're going to continue to keep helping people in your line of work. So thanks for everything you've
Absolutely.
done.
Yeah, you're very welcome, and thanks for inviting me to join you today.
You're welcome. You're welcome. Thanks again. Take care.
All right. Bye bye for now.